Welcome once again to my YouTube channel. My name is CJ and today I'm going to be breaking down USDCHF. So today, as I said, I'm going to be explaining my entry model on how I usually execute my trades. So if you know that you are suffering from that, make sure you get your pen and your book because today you're going to be learning a lot. So as you can see, we're on the monthly time frame. On USDCHF, there is a very nice opportunity, and I saw it and I said, no, I have to do a video on it to educate every forex trader on how I usually execute my trade and how I usually break down my chart from the monthly time frame down to the 15 minutes most time. So that is what I'm going to be explaining it. I'm going to be explaining in full detail. Now on the monthly time frame, as I always say, what do you usually come to the monthly time frame to do? On the monthly time frame, I do come to the monthly time frame to check for directional buyers. That is one. Two, I do come to the monthly time frame to check for candlestick formation or candlestick. Hope you all are writing down some key points. I just said many key points here. On the monthly time frame, I come to the monthly time frame to check for the directional buyers. As you can see, in this time frame here, looking at it from the layman perspective, the layman view, what can you see? Looking at it here, this is creating series of lower highs, lower lows, lower highs, lower lows. So this is automatically a bearish market, isn't it? But I will tell you that the market is bearish, overall bearish, but mid-time bullish. All right. If you ask me why did I say the meantime bullish, because if you check here very well, you can see that this market has created what they call a reversal pattern, which is called a head and shoulder formation. Now, what is a head and shoulder formation? A head and shoulder formation is a reversal pattern, signifying that if market was bearish, then just be getting ready for a bullish market. Now that is what the market is showing currently at the moment. So let me be using my line here so that I can be breaking it down very nicely. Let me zoom it. All right, so that is it. Now this is the point where I'm going to be explaining in detail. I will start again from beginning. As you can see, the market is bearish, overall bearish, but it has already created a reversal chart pattern, which is called the head and shoulder. In full detail, this head and shoulder is called the inverse head and shoulder. All right, when I using my my pattern tool, you could see it in detail. This is the left shoulder, this is the neckline, this is the head, this is the right shoulder at this point here. So that is how it is. If I go to the daily time frame, you see it in full detail. So this is the reversal pattern here that formed at the moment. But on the monthly time frame, I don't usually come to the monthly time frame to check for chart patterns. But if you see chart pattern on the monthly time frame, reversal chart pattern, just know that there is a 89% that the market will respect that chart pattern, because it took a whole how many months for this chart pattern to form. Why won't it respect it? Now looking at it here, you can see that the market created this reversal candlestick, also came back to create this reversal candlestick. Not just that, created all this thing on a key level. What is a key level? A key level is a high probable point that has been tested multiple times on a higher time frame, such as the weekly, monthly, and 3 months, and so on and so forth. These time frames are the time frame that has a very solid point of what? Liquidity grab. So just know that whenever you see a key level, it's a point whereby market always respect whenever it comes there. If it breaks it, it must always come back to retest. And if it comes there, it must surely react. Like looking at it here, market reacted here, it reacted here, it came back here, it has been reacting here, it broke out from here, reacted again, now it's currently going back to the upside. So that is what a key level mainly is. Now we're going to be going to the weekly time frame. What's the use of the weekly time frame? The use of the weekly time frame is to check for obstacles, to check for any bad boys in the weekly time frame. And any obstacles, just like a reversal pattern, any pattern that or any stop resistance or anything that may likely stop the market from heading to the upside. That's where we usually come to the daily time frame, the weekly time frame to check. So we're going to be going to the weekly time frame now. So here we are on the weekly time frame. Looking at it very well, you could see that the head and shoulder pattern is looking very clear. The head and shoulder pattern is looking very clear. If I should draw it again, you could see that this head and shoulder pattern is extremely clear. Look at it here. You could see it very well. For those people that didn't see it very well, like you can see, we have identified what the weekly time frame is mainly meant for. Number one, we have found out that the overall direction of this market is bearish, but because of this chart pattern on the weekly time frame and I also showed on the monthly time frame, is signifying that the market is currently bullish. The chart pattern showed on a key level. That is a high probable point that shows that the market is no longer interested in going down. It is now interested in going up. So this is a clue. So what are we going to be doing now? We are going to be looking for other points where that may likely stop this market from going to the upside. So looking left, you could see that this point here is the neckline of the head and shoulder, the inverse head and shoulder. This point here is the neckline of the inverse head and shoulder. What did you see here? The market came here, retested, pulled back up, came back here, made some reactions, went back down, retested back to it, went back down, retested back to it, went back down, retested, went back down, retested, went back down, coming back here again. Is also reacting at this point. So this point here is the neckline. If market can clear this point here, next target will be this point here, will be this point, will be that point there, 0.8368357 basic point. So that is where the market will head to the next point. So we have identified how many what they call it. If this head and shoulder is the one that will cause the market to go up, 1, 2, this is a resistance zone that is stopping the market from currently going up. If the market can clear the neckline of the head and shoulder, we'll be waiting for a pullback, the continuation. But mind you, we can also go to a lower time frame to check for possible way of taking advantage of this trade, because we have identified that the market is currently going up. So we are going to be following the direction of the market. If you check very well, the market, if you're using structure, you can see that the market has created what we call break of structure on the weekly time frame. So this is a clear break of structure. If you call, the market has created a low, high, lower high at the moment. So we are expecting an additional higher high before a lower low, then a higher low. Sorry, don't mind me, let me repeat it again. The market has created a low, high, higher low, higher high. You understand? The market is currently creating a higher high at the moment. Maybe this can just be a lower low, a medium time lower low, and medium time higher low before we're expecting additional higher high. But we don't know, so we're going to be going to the daily time frame to check for any potential, if you can be able to get any entry to the upside. Looking at here, you can see a resistance zone at this point here that has also started to support. So if you check at this point here, you can see the market tested this place multiple times. So market has reacted here, 1, 2, currently 3 at the moment. So this is what is holding this market here at the moment. So at this point, maybe we can be expecting a further push to the upside to break this resistance zone that's at the upside there, if you're using structure. So we're going to be going to the daily time frame to check if there's any other opportunities on the daily time frame. The daily time frame, since we have realized that the weekly time frame is bullish, monthly time frame is bullish because of the chart pattern, then daily time frame, if daily time frame can respect the two time frames that I just mentioned now, then we will be planning on catching the buy. So let's go to the daily time frame. All right, so this is the daily time frame. Looking at the daily time frame very well, you could see that this is what is in the daily time frame. You all know as we go down to the lower time frame, the market becomes more, the candlestick expands and become very nasty. So that is the reason why we check for the direction of the time of the market in the higher time frame, the monthly time frame to be precise. Then the daily time frame, we come to the daily time frame to check for point and area of interest. Most people usually call it order block, cement block, ice block, fair value gap, liquidity. It does not matter. The main thing here is that I characterize my own as an area of interest. It is an area of interest. It is not a point, because it is not just a point. It is an area of interest. So what characterizes my area of interest? My area of interest, you can also call it a liquidity zone. What characterizes my area of interest is many touches as you look left. Now, looking left, you can realize that market came here, it pulled back up, came back to the same point, it went back up, breakout, retested, came back to that same point. You understand? If I should draw my line to the upside, you could see it more clearly. Now, look at it very well. If it was a zone, you would have seen it very, very well, but I used the line. So look at it very well. Market came here, pulled back up, it came back down, retested, came back down, went back up, retested, breakout, retest, come back. So do you see the amount of touches on this place? Market broke out, retest, came back here, retested, came back here, retested, came back here, retested, broke out, now currently retesting. So this point here is a high probable point area of interest. Can you see how I characterize mine? Now, I don't need this down line. I should take it out. So this is how I characterize mine. So this is my area of interest, or you can call it a liquidity area of interest. You understand? A liquidity point of interest. So that's where the market is likely going towards buy from. Not just that, I don't just use only just this. I also use my Fibonacci level. My Fibonacci 2. How did I usually use my Fibonacci 2? I use the golden ratio in the Fibonacci 2, which is called the 50 to 60 Fibonacci level. So if this Fibonacci level I'm about to use now at this point matches this support line, this is my area of interest, then we are good to go. Because you know I'm a kind of a confluence trader. So this is it. This is my Fibonacci here. I come to the low and I drag it to the high. So looking at it like this, you can see that the market intersects as we speak. The market intersects at that 50 Fibonacci level at the same point where our area of interest is. So we are good to go. The market is in a very good position for us to go. So how many confluences do we have here? We also have a trend line. Looking at this trend line, most people usually draw that trend line at this kind of point here. Looking at it, they draw that trend line like this at the body of the candle. This is a very, very, very wrong way of drawing your trend line. You should always make sure your trend line touch the tip of your wick. The tip of the wick. Do you understand? What characterizes a trend line? 2 or more touches. 2 or more touches. 2 or more touches. You understand? So as you can see, this is 2 or more touches at this point here. Then we are good to go. Looking left, if we are lucky enough, we could also see a psychology level. What is a psychology level? A psychology level is a round number. Let me put this place. Let it be psychology level. This is a round number. For example, now this place now may be what they call it. So we'll be changing it to 0, 0. So as you can see now, this number like this now is a psychology level because it is a round number. So I may still be expecting this market to pull back down a little bit, but if it doesn't pull back down a little bit, what will characterize me to enter this trade will be my entry model, in which I'm about to explain. So I have 2 types of entry model. One is what I call the unlimited circuit breaker. It is circuit breaker. While the other one is what? King Sheddy entry model. Now, the reason why it's called King Sheddy entry model was because Oh, yes, it's FX-Sheddy entry model, or what's the name of it? It is a borrowed entry model actually that I refined to my entry model. So I borrowed it in order for me to reference to the person that I collected that I borrowed the entry model from. I have to reference him because it is not my entry model. I only use this entry model and I refined it to my pattern, to my edge. Now his name, you can check him on YouTube or on Telegram. His name is FX-Sheddy. Yes, it's his entry model I'm using, and it works. It works 70% of the time when used accurately. When used accurately. While the circuit breaker is my entry model, it works 89 to 80. It works 87 to 80 to 87 to 90% of the time when used accurately in the right position. When used accurately in the right position. It doesn't work most times when you're not using it with other confluences. For example, the top-down analysis, Fibonacci, area of interest, you understand? Correct pullback, matured pullback. Are you getting me? Very good. So I'll be going to my whiteboard, not blackboard, to my whiteboard to explain what I'll be expecting on the lower time frame, how I usually execute my trades. So please make sure you hold your pen, you grab anything so that you'll be writing down everything I'm saying. Alright, so I'm going to be explaining my model of entry. Please make sure you understand carefully. Now, looking at it here, with all things being equal, looking at this thing here, what can you see? You can see that this is a break retest. Now, I'm talking about after you've identified your area of interest, your hyperbole area of interest. Now, you should wait for a pullback. Now, what characterizes my entry model? Number one is the the FX-Sheddy entry model. FX-Sheddy entry model. What characterizes an FX-Sheddy entry model? The pullback must look steeper. It must just look with a bit of candle coming down. It must not be like something like this. The pullback, as I was saying earlier, the pullback must look something steeper. It must not have a zigzag, like a point where you can drag and place your trend line at the point. You understand what I'm trying to say? That is only when it works. The pullback must be something like this, a breakout, a retest. Do you understand? That's where it will be. But what characterizes it is that when it's retesting, it does not create a point where you can place your trend line. Just like this. Look at this point here at the right hand side here. Looking at here, you could see that the market broke out. While retesting, it was creating some little bit internal structure. You can see it lower, higher high, lower high, lower low, lower high, lower low, lower high, lower, then equal low. Do you understand? When market was retesting, it did not create something like this. That's when FX-Sheddy's entry model works. FX-Sheddy entry models works. If you see something like that one, then the FX-Sheddy entry model doesn't work effectively. Should I take it again? You have to wait for a breakout, a retest. When the market is retesting, it does not create an internal structure. It just pull back down. Series of candles just pull back down. That's when it works. But when you see something like this on it, then you should not use the FX-Sheddy entry model. Rather, you should use this next entry model I'll be explaining to you. So when you see something like this, the pullback should look something like this. What you should be expecting, a what? A weak rejection. Now, watch when this thing works. It works on the daily and the 4 hour. If the pullback is looking like this on the daily time frame, then you should either scale to the 4 hour to check for weak rejections or daily time frame also. If you should see a weak rejection on the daily time frame, you collect it. If you see a weak rejection on the 4 hour time frame, you collect it. These are only the time frame that you should check for weak rejection. I repeat, you can only check for weak rejection on the what? Daily or 4 hour time frame. when you see series of weak rejections like this series of weak rejections like this, you know what weak rejections are? Go and Google it. I won't tell you that. Go and Google it. Go and make the assignment. Once you see a series of weak rejections on the daily or 4-hour time frame, then you scale to the 15-minute or 30-minute. The 15-minute or 30-minute, immediately the weak rejections may change to this pattern. What is this pattern? This is a consolidation, a sideward movement. Once you see this, then you know that yes, you are good to go. Most times you may see weak rejection, but it may not look like this. If it doesn't look like this, then forget it. It may likely not work sometimes. So what are you going to be expecting? You're going to be expecting this to work. How do you wait for it to work? First of all, you look at the movement within that same, what they call it. You come here and drag a box within it. You will lock her inside calabash with no good. Here you get that kind of thing. So you come to this place here, you box it inside, you put it inside a box, then you observe it. How many times did it come like it want to break out of the box? You understand? Make sure that when you box it inside the box, the wicks are not outside. Rather, the wicks are inside. And the wicks that went out as if it want to break out is at the top, it's at the body of the box. You understand? Now, you should wait and see how many times did it do like it wanted to break out. Count it. 1, 2, 3. 3 is the minimum. I repeat, 3 is the minimum. So as the bottom 2, 3 is the minimum. It can be 3 and above. So far it is consolidating inside the box. If it created just only 2, forget it. It may likely fake you out. So be expecting 3 or more. So once you have seen 3 like this, then be expecting the next breakout. If you see a 15-minute or 30-minute engulfing, not the kind of candle that will engulf out from here, then leave a weak rejection and close here. It should at least give you 2 pips, 2 or 3 pips above. Once you see it, then the next thing you're going to be doing on the 30 minutes or 15-minute time frame is to come to this place here, is to come here, is to come to this point here. If you come to this point, your stop loss, I always put my stop loss at 80% of the box like this. Then your take profit can be the overall 4-hour take profit. You understand? The overall 4-hour take profit. That's where your take profit can be. You understand? I put it at 80% of the box. Most times I put it at this point, 100% of the box, but it does not pass there. If my shares should take me out, then I accept it. Are you getting me? I accept it. That's when risk management is always applied. Are you understanding? Then the other one of FX-Sheddy, because they are all the same thing. You understand that they are all the same thing, but most times market may not give you that consolidation that you are looking for. It may give you a chart pattern. Now, once you see a weak rejections on the daily time frame, it still goes the same way. Once you see a weak rejection on the daily time frame of 4 hours, scale to the 15 minutes or 30 minutes and wait for a head and shoulder. A head and shoulder. This is the left shoulder. This is the head. Then this is the right shoulder. If you see something like this, wait for a breakout of the neckline. Wait for the breakout of the neckline, a retest back, then an engulfing candle. Once you see a bullish engulfing candle at that same point, this will be your what? Your entry model. Then mark out the neckline first of the reversal candlestick. If you see it on the 15-minute time frame, mark it out. Make sure that the market broke out well and retest. Once you see market has retested back on the neckline of the head and shoulder, you see a bullish engulfing candle. The next thing you're going to be executing, you're going to be doing is what? You're going to come here, place your buy order on this point here. At that point there, stop loss is going to be at this point here on the neckline, and not the neckline, the head of the head and shoulder, the head. Then your take profit is going to be on the 4-hour or daily time frame take profit. That's how it's going to be. So this entry model gives you a very big RR. a very big RR. It gives you like 10, 1 to 10, 1 to 8, 1 to 15 most times, 1 to 20 most times, 1 to 5, 1 to 8. Are you getting me? So this is FX-Sheddy entry model that is done on the 15 minutes time frame. It works accurately once you use it exactly as I said. Put it into practice. Make sure you put it into practice. I'm telling you that if you put this into practice, I bet you will see positive changes in your trading activity. I bet you. I'm telling you. Once you try it, come to the comment section and testify and give your testimony. Yes, I'm telling you. But make sure you put it into practice before using your real account. Now, going to the other entry model called the circuit breaker entry model and how it works. Now, the circuit breaker entry model works when you see a series of this kind of movements on the daily time frame or 4-hour time frame. If you see when market breaks out of it and when pulling back down, it was creating substructure before coming back, before you now tap this area of interest which people usually call cement block, ice block, blocker block, you understand, popcorn block, you understand, other block, liquidity points, anything you want to call it in this life, everything is all the same. So far you see or you saw, any English you want to put, this kind of movement when the market was coming, that's when you apply this my entry model. This entry model works 85% all the time. 85% of the time this entry model works when used in the accurate way. So this is my secret and I'm sharing to you. So I'm expecting you putting it into work and believing that it will work for you. And when you put it into action and telling you the truth, I bet you will see a positive outcome in your trading activity. Now looking at this now, what can you see? You can see the market was creating a substructure before coming back to this support zone. After that, what am I expecting you to do? You should draw your trend line. I taught you how to draw your trend line. Two touches on the board, on the wick, not the body. Wick. If by God grace you saw two points here, drag it and let it flow. Don't be forcing markets. Don't be forcing your trend line to touch. Just drag 1, 2. So far market has not touched it, wait, it will come back to touch it. And when market will touch it, wait for something like this. I'm going to be explaining. You wait for market to react, pull back down, then break. Once the market has break out, make sure you see a reaction at this, like market want to break out. Once you see a reaction on this, you what? Wait for a bullish 4-hour. This work on the 4-hour only. I repeat, it works on the 4-hour only. This entry model works on the 4-hour and only. You can wait for the market to pull back on the daily time frame, on the 4-hour time frame. That does not matter. But this entry model works on the 4-hour. This one works on the 30 minutes, 15 minutes. This one works on the 4-hour. And its win rate is around 85%. Very good. While this one is around 70%. So you choose which one you want to be using, or you can adopt the two of them. Now, at this point here, you wait for market. When market has been creating series of this internal structure, you wait for market to come back to this trend line. Like it wants to break, it will be doing some reactions at this point. It will pull back, but the pullback that it will pull back, this one will be more lower than it. This one will be more lower than it. Instead of it to pull back down to create a lower low, no, it won't create that. It will create like it want to come and create a lower low, but it will not create a lower low. Then next you should be expecting is a break. Once you see that break, the next you're going to be doing is come to this place here and drag your what? A point here. This is what I call the circuit breaker entry model. That point there is what I call the circuit breaker. Are you getting me? Sometimes markets, okay, once you should see something like that, what you're going to be doing is come to this place, put your pending order at this point here. Market always does that. It will come to that point there and what? To come to that point there, comment please. I don't know why the market is doing like this. You put your stop loss at this point here. then your take profit is going to be above. Your take profit is going to be above of your 4 hour of your weekly time frame 100% Fibonacci level. So this is why it works. Now the difference between this one and this one is that this one gives you a lower risk to reward. This one gives you a bigger risk to reward. This one is the entry model works 90% of the time. This one, the 80% works 60 to 70% of the time, honestly speaking. But when you put it into your trading, what do you call it, trading activity, trading lifestyle, or your trading, I bet you that you will see positive and magnificent outcome. Yes, because the amount of money you'll be withdrawing here, you will testify in my comment section. So this is how I usually execute, and this is my entry model. So the other way or how I usually enter this point is that if market does not create this other circuit breaker, I wait for a breakout, a retest, continuation. So how do I wait for? I wait for like this market to come and retest back to the trend line. Go back, I execute. Most people usually come to this place here when they don't see one market break out from the trend line, retest and give a bullish engulfing candle here like this. Most people come here. Let me I'm coming. Let me clone this. What's going on here? Most people come to this place and execute at this point. They put a stop loss here and they think they are doing anybody. This entry model is a 50-50 entry model. So I came to realize that this entry model is a 50-50 entry model. So what do I usually expect? I usually wait for market to what? Do something like this. I came to a conclusion whereby if market should break out from a trend line and everything being equal as I've predicted in the lower time frame, just an entry model, and market should break out from the trend line, what will I be expecting? A break retest continuation. The continuation should always break my circuit breaker. And where's my circuit breaker? Here. You can also say that the circuit breaker is a what? A shift in structure, anything you want to call it, but it is my entry model and it is called circuit breaker. Why did I name it circuit breaker? Because once you see it works. It a catch. No be cho. It enters, it works. You understand? So what are you going to be doing? Put your stop loss here. You put your stop loss there. You put your pending order there. Why is this thing always misbehaving at the moment? Your stop loss should be here and your take profit should be on the 100% retracement level. So this is the ideology towards how I execute. Now, what characterizes this is mainly two. The entry model should, when market is pulling back, it should not be that steeper like this. It should be exactly like this. You understand? So that is the entry model of how I'm expecting. So I'll be going to the 4-hour time frame now of the main chart to be explaining what and how the market is going to, how I'm going to be executing my trade. So make sure you hold on and catch the ride. So this is the 4-hour time frame here. Looking at it with all things being equal, you could see very well that this place here, if I'm to adjust this my support zone here, and I should take out this my line because I don't need it, you will see that the market is currently reacting on this point, and this point is also the Fibonacci level. What I said earlier, I said I'll be waiting for let me see the pullback. If the pullback created a series of substructure. Now looking at it from here, market was creating series of substructure from here, creating the letter. It created a double bottom, went back up, retested to the double bottom neckline, but couldn't go up. It violated it. So if I'm to draw my trend line, I would have drawn my trend line from here. And what do you see? Market has violated the trend line. So like this, there's no how I could draw my trend line. If I'm to draw my trend line here, it will not work because market will have to come to this point here. We have to come to this point here before dropping back down, in which it is not how market moves. So what did I see? I just said that the market just came back down steeper. The market just came back down steeper. So what will I be expecting? I'll be expecting a series of reaction. What are you seeing here? The market is currently reacting. If I should go to the daily time frame, you will see that this daily candle is currently forming as a weak rejection. Look at it. The candle is forming a weak rejection. Look at it. It's forming a weak rejection. And if today, because today is Friday, if today should close bearish, should close this type of candle, should close like this with this indecision candlestick, and tomorrow too should close the same, next week should close the same thing, then we should be expecting a bullish market to the upside. But I'm a kind of person that I don't like predicting one way or the other. The main thing here is that I'm actually looking to catch this market up, but if market should not give that and I should see something like a bearish engulfing candle, then what I'll be expecting is my type 2 entry model, type 2 circuit breaker entry model, because this is a trend line. Market has broken out of the trend line, though it is not following the overall directional bias. So, but if I see it, I'm going to take the trade because it has characterized my entry model. So what I'll be expecting is a pullback, then what? A breakout. So once I should see that, I'll just come here and drag my my circuit breaker at this point. But this is good. This is only up. It does not work on the daily time frame. I'm just showing you that if you should see it, then be expecting it on the 4-hour time frame. Then you take your shots to the downside. Your stop loss should be at that side there. Your entry should be where I'm planning to put this here. As you can see, your entry must be here. Then your take profits will be at this point. So this is going to be like a 1 to 3 risk to reward. That is if this should occur. But you know that I'm going to be going to the 4-hour time frame in which it works. It does not work on the daily time frame. It does not work on the 4-hour and on the 2-hour time frame. It does not work on the 1 hour. It only works on the 4-hour. So this is it towards it. But I'm giving this cell a 30% possibility that is going to sell, and I'm giving the buy a 70% possibility that is going to buy. So I'm putting more odds on buying this thing because of the top-down analysis of this pair. So if I should also use an EMA, you could see EMA is also pointing that the market is currently bullish. So with all things being equal, I'll be using with all full confidence that this market will give me a very high odd of buying this pair. So the next thing I'm going to be doing is that I'm going to be checking for my entry model and apply proper risk management as I always do. The consistent risk management I use, I will never change it because it's what is keeping me inside the game and making me being consistently profitable. I repeat, if you have not been in my Telegram group to see how I execute my thought process, then you are missing a lot. So make sure you go to the description below and check for my Telegram group, click the Telegram link because it's below there. Make sure you click and join the Telegram group. Because on the Telegram group, I have a lot of sources, materials there that will help you grow. It will help you grow psychologically and technical wise. You understand? I'll be able to help you to generate an edge toward the market. I will help you to have a psychology edge and also a risk edge. You can also chat me up on the Telegram channel and I will reply your message. So that is it to this. I believe I've answered the question of how to execute properly. Now remember that patience is always key in this game. If you don't have patience in this game, then you are already lost. You understand? If you don't have patience in this game, then you are already lost. Now looking at this thing here, we have seen that market is creating the series of weak rejections. So what are we going to be expecting? We are going to be expecting markets to, if we could even see a 4-hour bullish engulfing like this, maybe market should create a 4-hour bullish engulfing like this. Are you getting me? Something like this. Then I will go to the lower time frame, 4-hour time frame. Let me take out this. I'll be going to the 15 minutes time frame. The 15 minutes time frame. Then I'll be checking for any possibility of market creating that weak rejection. Like you can see now, this market here has created one touch. Like see, when market came back down here, the market pulled back up.
it reacted to this resistance level here and the market pulled back down. It did not come down and created a lower low. It came and created a what? An equal low. You understand? So I'll be expecting this market to what? Create something on this 15 minutes time frame, something like this. This is going to be my exact entry model. That is the FX-Sheddy entry model I'm explaining to you all.
Alright, so this is what expecting like the FX-Sheddy entry model in which I refine to my edge. So you're going to be expecting. Let's assume that the market has done something like this. So we're waiting a little bit of correction to my previous explanation on that part. First thing first, you're going to wait for minimum 2 touches, not 3 touches. In that other part, I say it is 2 touches. It is 3 touches, but to be correction made, it is 2 touches. Like now, you could see that here, 1 touch, 2 touch. The upside is 1 touch, currently 2 touch. That is if something should occur like this, then the market should pull back down. Are you understanding? If the market should pull back down again, so it will be left with 1 touch, 2 touch. You get it? So market is currently heading to this point now. This place may likely hold it. This resistance zone here may likely hold it. Remember that this place is going to be in a box. So if market should create something like this, then then this place when coming back down, this place should hold it again, then it push it back up. If it wants to break it, it should break it. But this touches characterize the what I'm looking for. If it is only just 2 touches, like 1, 2 touch, that is here, if it's just it, and over here is just only just 1 touch, and the market should go up and break it, then it is invalid, because the market can just come and fake you out. But if the market should go up, react, then push back, now making it 2 touches on the upside, then maybe here 2 touches too, or maybe 3 touches, you understand? But the minimum is 2 touches, 2 touches up, 2 touches down, you understand? Then you are good to go. Not that the market should come down and touch it a little bit. The pullback must come back to this same side, you understand, to complete the sideways what movement, to complete the consolidation movement. If not, this will be like an equal top neckline break, in which I don't use that and it does not work. You have to wait for a very legit consolidation. Then the next thing, you can wait for a break. After a break, you should wait for a pullback. Then at this point here, you can execute your trade at this point. So before you execute your trade, make sure you put this into a box. You should box it something like this. Make sure you put it inside a box. All the wicks should be accumulated, all the wicks should be accommodated. So after the wicks have been accommodated like this, and everything are inside this box, so what you are going to be looking for is come here, place your pending order at the pullback, place your pending order at this point here. Your take profit should be above, your stop loss should be at the 100% or 80% of the box. This is how I usually place it. Most time, if I'm comfortable by putting my stop loss at the 80% of the box or 100% of the box, depending, it must not pass this level. You understand? If market should take me out, I'm okay by it, because that's when risk management is always applied. As I said earlier, risk management is what keeps me inside this game. Then my take profit will be at this point here, the daily time frame take profit or 4-hour time frame take profit. Mind you, this may likely be what may likely happen, but as the market is continuing, I may still come back to refine my entry model. So I can still go to the 4-hour time frame too. You all know that the overall take profit will be this, will be this weekly time frame resistance. So this may be like a 1 to 10 risk to reward. So as time continues, as the market keep going, we'll be locking in our profit. First target will be at this point here. First target will be at this point here. That's where our first target will be. Then the next target will be at that point there. So that is it to this video. Please make sure you like and subscribe. Make sure you like and subscribe, because this is a very valuable entry of mine. I'm not supposed to share it, but because I had to, and this was a question that was asked in the Telegram channel. So if you have not joined the Telegram channel, I recommend you to join the Telegram channel, because you really learn a lot of how I usually execute my trade on the Telegram channel, and you can be one of those who will ask me question and I will still come back here exactly the same way I did this to answer your questions. So have a nice day and enjoy the weekend.